Average true range is a very popular indicator. It can be used in many different ways. In this video, we will discuss if it can be used as a trailing stop loss. Welcome back, everyone. I am Ali Casey from StatOasis channel, and before everything, let me show you what is an average true range. Here is an illustration of the true range. If today's high and today's low engulf the day before, then that's easy. The true range is the high minus the low. But if there is a gap between today's low and yesterday's close, or between today's high and yesterday's close, then we need to add that distance to the whole range to get the true range. So basically, the true range is the whole range of today plus whatever gap is between today's low and yesterday's close, or today's high and yesterday's close. Although this is very easy to calculate, but you don't need to worry about it, as this indicator is available in every trading, in every charting platform. So let me show you how it looks like on the chart. So here at the bottom, I have the average true range for the past 20 days. It's basically calculating the true range every day, adding it for the past 20 days and divided by 20, so we get this curve. And there are two simple ways to use this average true range as a stop loss. So if we are long, we need to deduct this amount from the current close to define it as the stop loss. So let me zoom in here, and let's say, for example, I am going long here. So the close here is, let's say, 3980, and my average true range here is about 80. That means every day the S&P 500 in this case is moving by 80 points up or down. So if I put two ATRs, that means 160 points, theoretically, my stop loss will not hit as often. Now, instead of doing this manually by calculating this and plotting it here, we have another indicator that can plot this on the chart. So if you go to indicators, there is a trailing stop by Seihan. And if we click it, this is what we get. So basically, this is calculating the close minus the ATR and plotting this line as the stop loss. And if that stop loss get hit, then we will flip. We will calculate the low from the ATR. We can click on this, and of course, you can customize it. So in this case, I have the 10-period ATR with a multiplier of 3. That means I have the 3 times the average true range of the past 10 days plotted on the instrument. Here I have the gasoline futures, and the reason I put this is to illustrate the problem of the trailing ATR. You see, the gasoline futures is a trend following instrument, meaning it trends most of the time. And because it trends most of the time, this ATR trailing stop will work very good. So you can see here, if we entered here, you exit here. And if you entered short here, you will exit around here. Because the instrument is trending, it's hard to hit this ATR stop loss. The problem comes when we are not trending. So if we switch now to this phase of the gasoline market, we can see where we enter here, we exit at a loss. We short here, we exit at a loss. We enter long here, we exit at a loss, and so on and so forth. So when the market is trending, it's very easy to have this ATR trailing stop loss working very nicely with the system. But when the market is not trending, the ATR trailing stop loss will not work as good. Now, this is all good and dandy when we are looking at the charts, but of course, as always on this channel, we have to test to verify the theory. So here we have the gasoline futures, and I'm using a trend following strategy on this instrument. Like I mentioned, the gasoline futures works very good with trend following strategies. And in this case, I am using the linear regression as the strategy. The strategy is very easy. We will go long when the linear regression angle goes up, and we will exit when the linear regression angle goes down. So let me zoom in, and here we will see how the strategy is working. So look at the blue line here. So when it ticks up, we enter the market. When it ticks down, we exit. Ticks up, we enter the market. And here it ticks down, we exit. We are entering the next day, so that's why it's always 1 day late. And this is the performance of the strategy. It's making $100,000 with about $53,000 drawdown. Trade analysis, on average, we are making $895 per trade with 110 trades in total for the past 17 years. Here is an optimization of the look-back period for the linear regression. So from 20 to 200, step of 10, these are the results. And if I sort by return to drawdown, we can see 100, 130, 160, 110, and 80. We are doing very well. So from 70 to 160, we are doing very well with this strategy. I'm going to pick the best one to test the ATR trailing stop. Okay, so this is my strategy now, and 114 trades on average. We are making $1,300, 40% win rate, which is very expectable for a trend following strategy. And this is how the curve looks like. Now we will test if the ATR trailing stop will make a difference. So on the left here, we have the original strategy. We go long when the angle of the linear regression is up, and we exit when the angle of the linear regression is down. On the right here, we are entering the same way when the angle of the linear regression is up, but we are exiting with a trailing stop. And the trailing stop is optimized through the ATR. So we have the multiplier from 0.5 to 6, and we have the look back of the ATR from 5 to 50. So overall, 120 combinations. So we are looking to beat $151,000 in profits and $50,000 in drawdown. So sorting by net profit, we can see that we don't make a better version of the top optimized version. Remember, this is the top optimization, and here the top is barely close to it. But if I sort by the ATR, I can see that I have a stable region here. So this is 0.5 multiplier and different speeds. So 30, 35, 40, 45, and 50, they are all making good trades. So the average trade is very close, number of trades is very close, and the drawdown and net profit is good also. So overall, if I want to use the ATR, then this would be a stable region, maybe 0.5 and 35. So this is the multiplier and this is the look back, even though this makes less profit than this one. But remember, this is a overfit strategy on the left. Now I can optimize all of them together to find a stable region. So you can see here, I will optimize the look back, the ATR length, and the multiplier. So overall, I have 2,200 combinations. Now, since I have these variables, I have a 3D representation. I put the slider here at about $100,000 in profits. And here I have the net profit. So this line, here I have the look back period of the linear regression. And here I have the multiplier. So the third variable is listed here, which is the look back of the ATR. Now, what we want to find is a stable area. So let me scroll through them. So this is good. I can see a stable area here, and this is even better. So we can see here a lot of green shows up, and that tells me that this is stable. So now I can pick maybe this one, or even this one, and these will be a stable area. So let's see. So we have 25. Let's see if we have more here. And then nothing changed. So 25 is good. So, okay. Look back period of ATR is 25. And now I will pick this area. So this is 100 on the linear regression look back. And going from this side, this is 5, the multiplier. For trend following strategies, it looks like ATR can help a little bit. I'm not happy with it, but you know, it can be used. And this is where the ATR should shine. So of course, I expect a horrible result if I test it on mean reversion. So let's do that. So here on the left, I have the RSI strategy. Below 25, we go long. Above 75, we exit. And if we look at the strategy, it's $98,000 in profits with $26,000 in drawdown, 4 to 1 return to drawdown ratio. This is how it looks like. On the right here, I have the strategy with the ATR as the exit. So we enter when the RSI2 below 25, but we exit with the ATR trailing stop. So let's optimize and find out. So we're optimizing the ATR from 5 to 50. This is the look back, and the multiplier from 0.5 to 6. So here we have the original strategy of the RSI. RSI2 below 25, we go long. RSI2 above 75, we exit. And here on the right is the optimization with the entry RSI2 below 25, exit with the ATR stop loss. And we have many strategies that beats this number, but none of the top strategies beats the drawdown. So we see here we're making almost 100,000, 130, 929, 25, all the way to 110. But all of them make almost 1.5 to 2 times the drawdown. So yes, we make more money, but we suffer in the drawdown. Also, we suffer a lot in the number of trades. Here we have 242 trades. And over here, this one is 279, and this one is 104, and this one is 102. This is the only one that's above 200 trades. And this is the difference between the two. So this is an overfit strategy with the ATR, and this is the original strategy with only RSI. Remember, this strategy does not have any filter. So of course I can make this much better, and I have a million versions of this strategy on the channel to make it better. So again, the ATR here did not perform. So while ATR looks extremely nice on the charting software, and it makes sense looking at it, but when we test it, it doesn't perform as well. And actually, this is the case for all stop loss. Now, if you are a viewer of the channel, you've heard me saying this, that I don't use stop loss. You should use other ways to manage risk, or use a catastrophic stop loss where it is the last thing that you want to hit. It's much better to mix strategies, mix styles in a portfolio, and manage your risk that way. To learn more about trading, watch this video, and I will see you there.